Schlegman with BIS Commodities, taking a look at the week in review, and let's just start where we closed for the week. We'll start with corn down just a hair over 4 cents in the December contract at 358 and a quarter. The nearby September contract down 2 3/4, just a hair over 352 was the final settlement price there. November beans closed a half a cent lower at 1057 and a quarter. The nearby August contract down 10.5 cents, 1072 on the week. September wheat down just a hair over 10 cents, 424 and 3/4 last trade or settlement tick. In the meat market, August cattle's going to close $1.30 lower, and that's going to be at that 110.92 area. And today was the last day for July hogs, going to close about a nickel lower on the week at that right at $80. We did see the August contract close 90 cents lower at 77.92. Oil looks as if it's going to close a little stronger on the week, currently trading 70 cents higher in that 45.90 area. And the dollar looks as if it may close a little stronger in the week as well, up 30 points or so at 96.60. The main driver this week is in the grain markets, of course, was weather. But we did have our monthly supply and demand report this week. And just take a look at those numbers. For corn, keep in mind we had the previous 2 weeks ago, we had the quarterly stocks and acreage report. So we were able to incorporate the acres in our S&D this month and see how we were going to adjust the demand side of the balance sheet with the stocks. And if you remember, we were able to find 200 million extra bushels of corn. But when we did come out with a carry-out for corn for nearby, we didn't change a thing. We kept a 1.7 billion bushel carry-out. That was about 100 million less than the average trade guess, and that was basically right on with last month. We did see an uptick in demand on exports, which was needed to be done with the strong export program or sales we have on the books right now. But we did offset that demand number with a lower crush and a lower feed demand number. The surprise was with the larger stocks that we've seen, we would see a much bigger cut in feed demand. We didn't see that come through in this report. So it'll be interesting in subsequent reports if we see anything transpire as we see that demand number continue to grow. That's maybe something we don't see until the September report. We pulled that number forward and we dumped it into the new crop carry out. We incorporated the acres, the larger than expected acres, and we came in at just a hair under 2.1 billion bushel carry out, and that was a little over 100 million, also less than anticipated. And that was basically again due to the old crop stocks there. We didn't do much with the demand side of the equation in the new crop carry out. All said and done, 2 billion bushels is a large carry out for corn. Obviously, the corn carry out is going to be determined in the next few months based on yield, and weather will be the main driver there. Soybeans, quick look at those numbers. We were down 20 million for old crop stocks from last month. We were at 370. We reduced it to 350. We upped our export demand as well there. Export sales have been very strong to this point. And that came in about as expected. And then we incorporated the larger than expected new crop, the larger acres into the new crop balance sheet, and we came in at 290 million as a carry out. That was a little bit higher than what the trade had expected. We were looking at a 279. It was actually 30 million higher than last month's report. And again, I think the trade was looking actually for a larger export demand number to weigh on that carry out. So we have an interesting thing going on with exports right now. We have a very large record number of bean exports on the books yet to be shipped. The question is, can we physically ship these beans? How many will be rolled to new crop at this point, if not canceled, yet to be determined. So at this point, exports are exports, and it's new crop versus old crop. And that moving forward is going to be the question: is how much are we going to see games being played with export sales on a weekly basis, and can we really ship those sales at this point? The driver beyond that, beyond the Chinese demand at this point, and is weather. And weather is very volatile with forecast to forecast, and the trade is very volatile with forecast to forecast. This week we were looking at a high pressure ridge as we came into the week, setting up over the Corn Belt. Next week, by the end of the week here, we have seen the 11 to 15 day forecast back off that ridge and bringing in a little bit cooler and wetter air or weather, and that's why we did see the late sell-off here this week. A very volatile bean session, a 90-cent trading range in a 24-hour period in November beans, 30 cents in a December corn over the last 24 hours. And the main driver, again, is that extended forecast. Now the models, the American, European, and the Canadian models have had a tendency so far this year in that 2-week out forecast to overestimate heat and underestimate precip, yet to be determined at this point, but we'll know in a couple weeks from now what we'll see. So we continue to see the corn ratings and the soybean ratings continue to keep at a very high number in the good to excellent ratings. We're not looking for much of a change next week as well. And then the following week will be interesting after we do see this 100-degree temp move its way into the western Corn Belt, western and southern Corn Belt. And that sets ourselves up for a very volatile Sunday night trade this week as well, where we could see that heat come right back in, and we could see the managed money want to jump right back in on this thing, and or we could take more of it away and add more precip, and we could see a nasty cut or drop in the markets. That's the driver in the markets right now as far as corn and beans are concerned. Taking a look at the livestock markets, cattle seem to found a little bit of a bounce here midweek this week, only to see a sell-off here today. We did make contract lows in some of those months, but we were able to bounce back, only to see that sell-off. Cash looks as if it's going to trade 217, 218 area in the northern Corn Belt. The South yet to trade yet. As this broadcast, we're seeing the bids down around that 216 area, and we're seeing offers up to around 220. I would imagine 218 may capture most of the cash trade in the South. Boxes seem to have held firm for the most part this week. Looks as if a lot of traders are trying to pick a bottom in this market. We probably blew them out early in the week, only to see a little bit of a setback here. Again, unless there's a drastic change in cash in the South, I think we're still going to carve around in here and still try and find a bottom in these futures markets. Taking a look at the hog market, very ugly there. Pushing, making lows for the move in several months. We've seen 8-9 day consecutive lower closes in December hogs. Cash has backed off a little bit this week as well. We're seeing the cash and the cutout continue to back off. The trade's still bulled up on exports, which have been good to this point this year, but we are expected to be great. We'll see how the last half of the year pans out. The expected huge demand from the Chinese at this point, but we'll keep in mind that the pig report did show larger than expected numbers. I think we're due for a little bit of retracement here in the hog futures. In any type of retracement in there, I think we still need to find some spots to at least get ourselves protected in some of those deferred months. So if you have any questions about these or any other markets, please feel free to give us a call here at BIS Commodities at 1-800-373-2525.